I think you probably see a little bit of a pullback in the banks, given they've been so rate-driven over the last 3 to 4 months. The market has been hypersensitive to rising interest rates and the potential for deposit repricing. We've seen deposit betas or the repricing of deposits be a headwind for many banks. And given that interest rates have been moving higher and that we were going to see a pause from the Fed, a lot of the regional banks have pulled back and are now trading at levels that would be considered pretty attractive, below 12 times earnings.
Which banks are most sensitive to deposit repricing?
Some of the highest sensitivities are going to be Citizens Financial, ticker CFG, and Capital One, COF, that have online deposit bases and online offerings that tend to be higher priced. And so you probably see deposit repricing at a faster clip for those two in particular.
How big a positive is it that longer-term rates have been moving up finally?
Longer-term rates are clearly a positive. If you see rates move up across the board, it is positive for banks, given that we're going to see higher spread-based revenue and higher margins across the board. I would caveat that and say that a lot of the large cap regional banks have shortened the duration of their balance sheet and therefore are more sensitive to the shorter end of the yield curve as opposed to the longer end. Traditionally, when you think about the banking sector, a steeper yield curve was always the biggest benefit. So if the 2-10 spread was very wide, banks would do well. But given that they've shortened their duration so much since the financial crisis, I would be looking closer towards a 3-month to 5-year spread as opposed to a 2 to 10 spread.
So what breaks the market from its psychology that 2s, 10s reign supreme when it comes to the bank trade, when it should really be a shorter duration spread that drives this trade?
I think you unfortunately have to go through another cycle or a recession before we start to see how banks truly will perform in a downturn. I will say that they are much more conservative in their underwriting. Regulators are much more sensitive to banks creating asset bubbles, and therefore I would almost argue that they're defensive in a downturn, given the limited amount of credit risk that they've taken. I'd also note if we start to see a downturn, the yield curve should steepen and spread-based revenue should increase. So therefore, I think banks ultimately right here, especially with the valuations where they are, should be defensive if we do go through a cycle here.